For more, I spoke with CLSA analyst Brian Johnson, who says he was surprised that the Commonwealth Bank and ANZ followed Westpac in hiking rates. Brian Johnson, thank you for joining the business.
Thank you.
We've seen Westpac raise their interest rates by 14 basis points, the Commonwealth Bank by 15 and ANZ by 16. Does this just reflect their increased borrowing costs?
No. What this basically reflects is, and there's a whole lot of things that move all different ways, but the first thing is we can see in Australia what's called the 90-day bank bill rate has gone up quite dramatically. It went up in March, then it improved and it's gone up and it's subsequently improved a bit, but it certainly is well above where it was. And what it does is that triggers basically an increase in the cost of banks swapping back their overseas funding to the A dollar. And basically that's what has basically gone up. Now, over and above that, however, banks, you might recall, repriced up interest-only loans. Customers get annoyed with that. They switch to principal and interest and your margin fades. So really what happens is this is not just capturing the swap, but on my maths, it would also be catching that interest-only repricing dynamic as people switch back.
So is this more about them just fattening their profits?
Well, otherwise their profits would go down. But the reason their profits would have gone down is last year they went up because the interest-only repricing. So really what we're talking about is the banks defending an artificially high level of profitability from the year before.
Three out of the big four have already gone. Is NAB a near certainty to follow?
Yes, I would have thought so. That's coming from someone that didn't necessarily think everyone would follow Westpac straight away. Westpac faced more NIM pressure than the other banks, and it really comes down to they have got a much bigger interest-only book, and basically they had an amazing treasury result in the last result. So if Westpac hadn't gone, I would have thought earnings next year would be down on this year. So Westpac faced more pressure, and that's why they went earlier. But I must admit, I am a little bit surprised all of the other banks have followed.
Well, does this prove that there is a banking cartel at work in Australia when we see the banks pushing up prices in unison?
Carrington, I'm appalled that you use the word cartel. The politically correct word is oligopoly, and it's hard not to conclude that is the case. What I'd also flag, which often gets kind of lost in the messaging here, is wholesale funding costs. The cost of swaps have gone up across the book. But what's happening is the only place where banks can really have the pricing power to kind of offset that is in housing. And so what is happening is housing profitability in Australia is much more profitable than banks make overall. And once again, we can see banks going to where they've got the pricing power to lift the rate, which is the poor housing borrower.
The banks still face considerable headwinds. We've got the Banking Royal Commission with another session before it hands down its interim report by the end of September. How bad do you think that could get for them?
Oh, there's no doubt about it. It generates... Well, the first thing I would caution you about the Royal Commission is you're not going to have the case studies that say the banks are doing a great job. So all the case studies are actually going to be pretty extraordinarily bad, and they're big organisations and there'll always be bad stuff kind of happening. But that being said, when you think about the implications of the Royal Commission, the fact is that it's pretty clear the banks have, well, it seems to me that the banks have broken some laws. So we're talking about some kind of financial penalties. But the point is that the existing penalty structure under the Corporations Law isn't particularly onerous. So I'd flag to you this thing about gigantic legal penalties that fly from it they're just unlikely to be that dramatic. But the bigger implication is I would have thought that during the Royal Commission it would be a brave bank that would increase its housing pricing, and that has now proved to be 100% correct as we see the oligopoly basically perhaps exceeding common sense. And this really does create a bit of an issue politically in Australia.
Why would the banks do this, hike interest rates, before the interim report at least is handed down?
Well, I can only guess on this. Because Westpac faced more NIM pressure than the other banks, they were looking at earnings going down next year on this year, and that's a tremendously negative signal. And so Westpac were under more pressure. But I suppose the point is that to the extent that Westpac have now repriced, you now introduce a real risk that someone increases the bank levy, be it Liberal or Labor. And if you're going to increase the bank levy, then you may as well get in and reprice up your home loans right now. And that's what I think has basically happened. Could be wrong, but that's certainly my reading of it.
We've also seen Westpac do a deal with the regulator where they admit putting people potentially in loans that they cannot afford. They paid a $35 million fine, which they can obviously afford, but does this open up the possibility of class actions?
Carrington, I'd like to stop you there. What Westpac have basically admitted to is that they didn't go through all of the procedures to verify that the loans were responsibly lent, which is slightly different. And so what we've seen is Westpac take a $35 million fine. Now, $35 million sounds like a big number, but for something like Westpac, it's really not very much. Now, as far as the next level of that, is that under the responsible lending legislation, as I understand it, if I lend you money that I shouldn't have lent to you because you couldn't afford to repay it, then that whole contract can be voided. So what that means is that if house prices fall so far that people who've got irresponsible loans would incur a loss, we can basically reverse the contract. They can effectively take their house, hand it back to Westpac. The point is that house prices would have to fall a long way from where they are now before that would likely be a meaningful number.
Is there any possibility of that occurring? We know the housing market has already turned. Prices are under pressure. Could it get that bad?
It's off somewhere between 5 to 10%. It's also up about 50% from where it was 3 or 4 years ago. We're really talking about it's got to fall a long way before we get back into that, before people would actually be behind. They certainly don't make as much money as they would have, but I would say to you, I think at this point, the chance of having material, basically losses in that regard are insignificant.
We also have a very important federal election on the horizon. The Labor Party, which is currently favourites to win, does have policies that would involve changes to negative gearing and capital gains. The government has claimed that that would take a baseball bat to property prices. Do you agree?
I think there's a real risk that it would. But I don't know that that's necessarily a bad thing either. So, you know, at some point, high house prices feel good to an old bloke like me, but they're not very good for my children. So perhaps it's bad for their inheritance. But the Labor proposals, as I understand them at this point, and it's not 100% clear, but what they're talking about doing is removing the negative gearing and 50% concessional capital gains tax discount on existing housing. Now, they'll grandfather everything else, but the best way to think of it is this, is I buy a house or an apartment off the plan, it's a new property, I can negatively gear it, I get the capital gains tax discount. I sell that property to you, 3 or 4 years later it becomes an existing property, you can't negatively gear it and you don't get the capital gains tax discount. Will you pay as much for it as I paid? So given that I'm probably looking at a loss when I buy it, I probably need to be more compensated with a rental yield above my cost of borrowing. That equals either rents go up or prices go down. Over and above that, there's also a proposal to actually change around dividend franking. Now at the moment, the excess of basically my franking credits over my tax bill, I get that back in the hand as basically a cash refund. They're going to carve pensioners out from this under the proposal as I understand it. But what we're talking about is basically removing that. Now I think that diminishes the appeal of basically franking credits for a lot of investors. And when you have a look at the excess source of franking credits in the Australian market or the excess source of dividend yields, it's all banking stocks. So these things are actually probably quite negative for banks. But there is one more thing to think about, and this is probably the most significant one, which is that with the banks now having repriced up housing, that's a de facto interest rate tightening that now ripples through the economy. Now, if NAB follow, it's about 1.5 billion, it's about 0.5% of retail sales. Every time you do that, it diminishes the ability of the RBA to actually increase interest rates. And the problem that we've now got is we can see pretty clearly interest rates in the United States will continue to rise. That probably means that if we can't raise interest rates in Australia because of the degree of household indebtedness, the $A goes down. Is that a disaster? Well, if I'm a US dollar benchmarked investor holding Australian banks, that is a disaster, so I sell now. So all these things are linked, and it all probably points to the fact that even though I sit here and I tell you the Australian banks look ridiculously cheap, I think they could trade even cheaper.
You say that taking a baseball bat to the property market might not be a bad thing, especially for those people who maybe are trying to get into the property market, but how bad do you think the damage could be?
Well, you can always change it, and you know, if house prices really fall, you can always the Reserve Bank could always cut interest rates. Now, what happens to the $A if the RBA cuts interest rates at the same time? So, you know, when you go through this from an equity investment point of view, I'm inclined to be more bearish on the $A per se than I am houses. Because at the end of the day, we've got $1.7 trillion of mortgage debt, which is a big number, but we've also got a 1.5% cash rate, which looks high compared to other parts of the world. So there is always the capacity to basically cut interest rates if this was to become a disaster. And the other thing is that we're yet to hear the exact mechanics of Labor's policies. But certainly from what I hear at the moment, it feels to me as though it would be potentially negative, certainly for house prices.
Brian Johnson, we'll leave it there.
Thank you.